We're now recording today's webinar in our Santa Monica series from Talking Hedge Events. I would like to introduce Meg Bodie, the president and founder of Talking Hedge Events. Meg, take it away. Lead us into the conversation.
Sounds great. Thank you, Ken, and good morning, everyone, or good afternoon, as the case may be. Those of you in California, it certainly is early. I don't envy you for that, but if we were there, we'd be getting together right now, and I do want to say I'm so sorry. We tried so hard to get to Santa Monica, and we were so excited to go there for the first time in 2020, but obviously it's just not going to work out. So I can't give you coffee or snacks or anything, but I'm very fortunate and very delighted to let you know that almost everyone who we had as a participant and sponsor for our original plans that were supposed to unfold last March has stayed with us, and we have a terrific program. We have 6 webinars in this series, so it will unfold really like a virtual conference over the next several weeks on Fridays in this time slot, and we hope you can join us for more than one. This is our opening. I want to thank everyone for joining. And I would just want to, as Ken said, we'll try to get a recording to you later. But in the meantime, please do note that we like to operate under Chatham House rules. And the comments made by all of our speakers are their own, not necessarily reflecting the opinions of the firms for which they work. We have a really exceptional group of speakers today. Justin Young came on board at the last minute. We're really excited to have an allocator's perspective, terrific managers, and of course, many of you know Chris Solars in his consultant role, who will be moderating the discussion. I'll turn everything over to Chris in just a minute, but I do want to, a little housekeeping. I want to thank Crable Capital for being the lead sponsor here. They were very excited that we were going to come to Santa Monica and really stepped up. Thank you, Lisa, and the whole team over there, and glad to have Grant here. They'd be shaking hands and giving you coffee too, but it's just not the day for it. Also, InfraHedge, the State Street Division, and they will be participating on a different webinar. Aspect Capital has been a consistent supporter of ours, and we're so grateful. It really allows us to get all of these webinars out to you all so that the industry can stay together and keep talking. Bodie Research Group, Camden Asset Management, FAR Capital, Innacap, Martlet Asset Management, Rowe Asset Management. Ryan O'Grady's here today. I know Andy Schneider's on. Many of you know both of them. TD Securities and Vidrio Financial will be on board next week. We'd also like to just mention our association partners, AMA, Kaya, CASA, and in this instance, Cal Alts. We want to thank them for helping us get the word out. We're going to talk about macro strategies today. Big topic, lots to talk about. I'm going to sign off. Chris will prep everybody, let you know who he is and what the plan is for the discussion, and then all of our participants will introduce themselves and we'll get going. And please do send your questions in. We want to make sure we're talking about what you want to talk about. So thank you and enjoy.
Well, thank you, Meg, and thanks to everyone who's dialing in from home. Hope you're all safe and healthy. The theme of our panel today is called Macro Strategies, Exploiting Their Power to Protect a Portfolio. And I think it's probably safe to say that this Talking Hedge Conference is the second most important global event today, behind Trump's game-changing coronavirus announcement this morning. I think we're all digesting that. But just as a preview of what we're going to talk about today here, we have really 3 themes. We're going to talk about the past, a little bit of history of systematic macro, the present, how investors are thinking about investing, and the future, how building portfolios today can help protect portfolios in the future. And we have a great panel. Of the 5 of us, 3 of them are thematic macro hedge funds directly, and 2 of us are allocators. So we have a nice balance here between GPs and LPs. And before we get into it, I would love to let each of them introduce themselves and their firms. So in no particular order, Grant, would you like to introduce yourself and your firm?
Sure. Thanks for having us. Thanks, Meg. Thanks, Chris. Grant Chafarian. I am a portfolio manager at Crable Capital Management. We're approximately $5.8 billion quant systematic trading firm. We have 4 products. We have a soft closed flagship product we call the multi-product. About $2.5 billion in a product we call Gemini, which is an uncorrelated medium frequency product, so about a 10-day hold vehicle there that particularly targets sort of long volatility, positive convexity trading opportunities. We have a trend following product called Advanced Trend, about $1 billion in assets. And finally, we have a product that targets a negative exposure to global equities that we call Contra. In total, we're about 85 people based in Los Angeles.
Great, thank you. Anush, are you joining us from London today?
I am indeed, Chris, and thank you for having me on. My name is Anush Lachin. I'm portfolio manager at Aspect Capital on the systematic global macro strategy. We've been developing strategies, myself and my colleague Asif Noor, for approximately 20 years. In the last 4 of those years at Aspect. Some of you may know Aspect as one of the kind of founding fathers of quantitative portfolio management in London. Been in business for approximately 25 years, primarily trend following strategies, but for the last 4 or 5 years, as I mentioned, we have developed a systematic macro strategy, which we're going to be talking about today.
Yeah, that's right. I think trend following is certainly a theme across all 5 of us, but we're also going to talk a little bit higher about systematic macro and macro in general. Ryan, you are joining us from California today. Is that correct?
That is correct. Yeah. Hi. Thanks, Chris. Thanks, Meg. So my name is Ryan O'Grady. I'm the CEO of Row Asset Management, which is a systematic global macro firm based in Newport Beach, California, but we also have an office in New York City. We're 1.5 billion under management, and the great majority of that is in our flagship Row Diversified product, which is a trend plus. It's a variety of strategies with trend following kind of at the front, but a number of non-trend carry value mean aversion type strategies mixed in, meant to be sort of an all-weather approach or our solution to the all-weather problem. And so at the firm, I'm primarily the head of research here, so I have a lot going on with the research people, and a lot of the questions today kind of go right into the problems that we're trying to solve.
Great. And Justin, last but not least, could you say hello and tell us a little bit about your role?
Yeah, so my name is Justin Young. I cover the hedge fund portfolio here at South Carolina Retirement System Investment Commission. We're a $30 billion state pension, and we have a $3 billion sort of low beta, leans towards relative value hedge fund portfolio, run over swaps and futures and that sort of stuff, mostly on the fixed income side with our synthetic exposure. But we've got exposure to pretty much every hedge fund style you guys have seen, and macro and systematic and discretionary CTA are all sort of part of that mix.
That's great. Thank you. And my name is Chris Solars. I cover macro and relative value strategies for Cliffwater. We are an alternative investment consultant. We advise on about 75 billion. We have large public pension funds. We have some smaller ENFs and about 50 institutional clients in total. And I've been at the firm for about 10 years. And I think that's it. That's it for intros. And I would love to start really with the theme of this conference. And the question, of course, is how should institutional investors be thinking about using macro strategies to tailor their portfolios to this current environment? It's kind of a big, all-encompassing question here, but it really is the most important one. Anush, perhaps would you like to kick us off?
Sure. So I guess it's like any other decision institutional investors have to make, and for us, it's all about diversification. I think Ryan touched on kind of the all-weather term. Ideally, investors want to make money in kind of all scenarios and all market conditions. And I think what systematic macro gives a client in their portfolio is some protection, some well-needed diversification during market stress periods. And we certainly think of that as one of the most important things that our particular portfolio gives a client. And I think for them, that's probably the most important thing. We run a pure RV book, so no directionality, very little trend. Just really trying to play different markets globally against each other, where the opportunity sets allow us to. And generally, during periods of market stress, when correlations start to kind of maybe untangle a little bit, asset dispersion goes up. That's usually a welcome time for us. It equates to opportunity for an RV manager, and that's really generally when institutional investors need the most help and assistance in their portfolio.
Yeah, I think relative value, and particularly technical relative value strategies, are so complementary to almost any portfolio, because at the core of most traditional portfolios, you have value, you have bottoms-up stock pickers, and you have private equity that's all fundamentally based on buying low and selling high. And these types of strategies are very, very complementary, which is why we're here talking about them. Ryan, could you talk a little more about this all-weather approach? I think it's quite important to think about this. Particularly, we just had 2019 runaway up 30% year, and then the start of this year was chaotic, and now we've had another rally. So to be all-weather through that cycle has been challenging, but ultimately, I think it's what investors want. They want consistency. Can you talk about that all-weather approach?
Yeah, so I mean, really what we're going for through that, let's just go right through that exact period of time. So, you know, the numbers you're talking about, those I think would be equity numbers. So equity were up 30%, they dropped 17% in the first quarter, and they've recovered and even then some since. So equities and you know, the great majority of what's inside people's portfolios are some sort of view-based, or I mean, we'll use the term biased. They have a belief that equities go up, or that bonds go up, or that private equity is a good idea, or things like that. The performance of those assets are somewhat out of their control. So they're, you know, if all things go the way they've gone in the past, that portfolio should work out, you know, well, and it has worked out well for a long period of time. But when we look at our investment approach, it comes without bias. It's completely adaptive. And so, you know, when the first quarter of 2020 hit and we looked at how we did, which was pretty well, it was a function of we adapted to a risk-off environment. We adapted to falling, you know, EMFX and you know, a variety of different situations that were there if you were an adaptive, unbiased strategy to go after. And then the contra to that is, in a year where just being long equity, like in 2019, was the best strategy, strategies like ours will underperform because they're sort of chasing things that never really come to fruition. So, I mean, when we think about, you know, how we balance and mix into our clients' portfolios, I think it's not even so much the correlation element of it. It's more just the philosophy of approach, that our approach is adaptive. And so it's a good balance to people's sort of more sort of predisposed or biased approach to sort of owning traditional assets.
Yeah, I completely agree. And in order to be this completely adaptive, you also have to be perhaps innovative, right? And constantly thinking about what isn't working and what is working in your portfolio. Is that part of your process as well? Constantly reevaluating everything that you have and tweaking and changing for the future? Yeah,
because the participants in this arena are constantly doing the same thing. And so, I mean, all of us on this panel have seen papers where people took a very simple strategy and projected it back 30 years and said, look at this, if we just do this rule you can fit on the back of an envelope, you know, this is really, really profitable. Well, I don't, you know, it's hard to say if that's really going to be true the next 30 years, given the level of sophistication of the frontline participants now versus then. And, you know, some of the consumers of those types of products have been disappointed that they're not performing the way they had. So, I mean, that's evidence that innovation is completely necessary. Just, you know, that's an empirical piece of evidence for that.
Yeah. Justin, maybe we'll jump over to you. As an allocator, how do you think about macro's role in your portfolio?
Yeah, so we've got mostly market neutral strategies, but we do recognize some of our strategies have, you know, sort of a, you know, left skew, sort of fixed income arbitrage and those sorts of things. And we use, and there's certain strategies that just do poorly in weak liquidity, like convertible arbitrage, for example. And so we have CTAs and discretionary macro and systematic macro as generally a diversifier in sort of these periods of stress. That's so. If you think about like your traditional asset allocation, we treat our hedge fund allocation somewhat strategic in that nature. And then CTAs and macro discretionary sort of feel the, hopefully are performing well. And then you could sort of see that happen this year. So if you want me to go any more deeper than that, but that's sort of what we use them for in our portfolio.
Yeah. Yeah. From my perspective, at the beginning of the year, our firm investment committee, we made a slight tweak. We downgraded credit within the hedge fund, within hedge fund sample portfolios, and at the expense of market neutral. We kept global macro the same. And this was before, this is of course before coronavirus. I think what's happened since coronavirus, the rally has been so unprecedented. Clients are still feeling that they don't want to invest in equities. So we see this push into market neutral, into relative value. And interestingly, because macro often thrives in global economic turning points, and we think about the elections coming up, we think about this pandemic that is underlying everything, we think about all these big unknowns right now. Macro is I'm getting a lot of interest in both discretionary and systematic macro. But interestingly, I just saw I think it was a Morgan Stanley piece that showed asset flows are actually going into some of these long biased health and biotech names that have, again, investors are chasing returns, which of course we all do sometimes. But I think the smart money and a lot of our clients are actually asking a lot more about relative value, market neutral, and global macro. Maybe I could jump to you, Grant. Could you tell us a little about your philosophy with macro and how it fits within portfolios?
Yeah. Well, just to piggyback a little bit first on Anush and Ryan, I think, we mentioned dispersion in Anush's cases from a relative value perspective. Ryan talking about agnostic position directionality, and that allows for the opportunity to make money. When we talk about the category of macro, one of the issues that we run across is it's just such a broad designation. And I think taking a step back, and this is where we sort of fit into the puzzle, I think you sort of have to think about how that category has evolved over the years. Because, we're sort of looking back on 11 years now with a couple of hiccups where essentially being something like a passive beta participant in markets is probably a higher rewarding sharp opportunity than is, some of these other dispersion-oriented characteristics we've talked about. Essentially taking advantage of positive convexity or long volatility has been disadvantageous. And when you mold that into an environment where hedge fund fees are declining, the reality is, which really was 08, 09, that was the case, what essentially you have happen, I think, for a lot of macro managers is a tendency towards running more assets while your revenues are declining, which sort of puts pressure on sort of raising assets and away from alpha creation. And when we talk about global macro opportunities that have the ability to potentially help you in February and March, and yet still hopefully create a positive expectancy elsewise, there's been a lot of pressure to shift away from that as a focus. And I think one of the issues we have is when you take a large sort of lump picture of global macro and you say, well, they're going to be there for me in February and March. The reality is, even on a trend following portfolio, it's been very tempting as a trend follower to go from, say, a medium type look back to 600-day look backs, which I think a lot of folks do. And you may not be available for 08 like you were back when 08 happened, because you've had this shift away from alpha production. It's become expensive, and passive investing has become much more in vogue. And so what do you do about that? And I think from a Crable perspective, we sort of looked at that and we said, well, if we're going to create alpha genuinely, there are a couple things that I think have to be relatively true from a macro perspective of our philosophy. One, you have to target as best you can positive convexity, long volatility trading. In a way, you have to find a way to make money, in particular in February and March when these events happen, because we're now dealing with this microstructure dominated by high frequency traders that create these huge volatility spikes after years of calmness. And yet, then when you have these prolonged periods of quantitative easing, you sort of need to have a positive expectancy there as well. And as a firm, that's sort of always been our focus on alpha creation. The problem is it's difficult and it's expensive. And I think from an investor perspective, I love hearing Justin's perspective, your perspective, Chris. It's really tough, right? Because I would imagine, as a asset deployer, you're sort of looking at this and saying, look, how can I give assets to a global macro manager that really has a low Sharpe expectancy potentially when things have been screaming good on the passive side for a couple of years. But if you favor those guys with the higher Sharpe during the quiet periods, it's reasonably likely that they're going to look an awful lot like the rest of your passive portfolio when something happens. So, for better or for worse, and I think I heard that in Ryan and Anush, as a global macro manager, we're really trying to focus on the positive convexity orientation so we can be available for those moves. But it's tough, right? That's alpha in a sense.
Yeah, and you know what I've learned from covering global macro managers all these years? I love how you talk about positive convexity, long ball, because this is how portfolios should be run in general. And this is how a hedge fund should be run. And the disappointing thing is when you see long biased, long short equity, or even market neutral long short equity, typically there's negative convexity. You have, frown charts. And your point is a very good one as well. Macro it's not necessarily negatively correlated. If you want negatively correlated, you have to be explicitly long ball. You have to be buying options. Macro is uncorrelated. And, we had some winners and we had some losers in March. And I think that was disappointing for some investors because, they're expecting macro to play this very specific role where it can have positive returns and positive convexity, which is a very challenging proposition from the portfolio management side. Maybe we can shift into investor expectations about what the profile should look like. Anush, I know you work with a lot of clients, and what are clients asking for specifically today, like looking forward? Are these kind of strategies, resonating with your clients?
Absolutely. I think Ryan kind of covered this as well. It's about being adaptive. So in situations like this that we find ourselves in, like this year or maybe 2018, kind of sitting on your hands and doing nothing, it's probably not the best thing. So if you have your program being adaptive, being dynamic, and that's kind of, I guess, what we all do. We have no biases to begin with. We kind of look to the future and where the opportunities lie, and that's exactly what clients want at this point. Their strategic allocation is separate to this. What they now want is you to dynamically, change their portfolio to adapt for the coming months or years and the situation we find ourselves in. And certainly from the client meetings we've had, that's certainly what we've seen, and the demand we've seen has kind of picked up in the last 2 or 3 years.
Yeah, maybe we can run with this theme of adaptability, because I think like most investors or people on the client side, I'm getting a lot of inquiries about the upcoming presidential elections. It's very much top of mind for portfolio risk management right now. And probably like many of you, I woke up this morning, checked my phone. I saw that it had blown up with this Trump coronavirus story. It's clearly a game changer for the election. And I checked the prediction markets just now. And interestingly, there's a 12% chance, according to Predictit, that either Pence or Harris actually emerges as the president. That's like almost doubled or tripled since overnight. But what do systematic managers do? Like when you guys are thinking about these type of binary events, is it so simple to say the models will adapt, or is there any, game theory or top-down evaluation of how your models might do under certain scenarios? Grant, you think a lot about this, I know, and we've talked about it.
Yeah. Look, there's no perfect answer to this. I can say a couple things there, though. One, certainly, as you sort of build and educate your systematic approach, doing so with the cognizance that there are going to be idiosyncratic risks that permeate sort of volatility spikes and cause some issues in that regard, predisposes, ideally, your legacy infrastructure and strategy side to sort of be positively attributing P&L during those sorts of events. But taking a passive approach is not our mindset here at Crable. We're very aggressive in thinking about how we can figure out that which it hasn't occurred yet. Now, you're never going to be able to perfectly anticipate it, but there are some things that are reasonably likely coming into an election. probably volatility is going to dwindle somewhat. We've seen that on the interest rate side. Equities are going to try their best to march towards highs if Trump can have his say, which, we'll see if that occurs. But there's likely to be significant volatility the day of, day after, day around. So, what do you do about that? Again, I think you model ahead of it. And we're 100% systematic, and we're not trading any options whatsoever. This is all directional, sort of one delta, single delta futures and FX. But you prepare yourself from a risk standpoint. We tend to be very aggressive as a firm, not just in sort of a top-down sort of VAR capping, max loss sort of scenarios, which are very important and strictly enforced, but really sort of kind of a bottoms up, right? What's happening this very instant? Because it could be the microstructure is changing on you on really a second by second level, and perhaps negotiating the same throughput you were accustomed to 5 minutes ago is unreasonable. And that is a big part of a systematic manager's approach as well, thinking about that micro risk management as you sort of step into these sorts of events. Sitting back and just hoping for the best is absolutely not acceptable. That doesn't mean you're not systematic. It just means you have to prepare for that which you have not yet seen. That's our view.
Yeah. Ryan, I think if I asked you the same question, I think I would probably know. You talked a lot about being not reactive and kind of agnostic to these specific binary events. But what about the big themes that are relevant right now? Like the fact that interest rates are near zero, they're negative, fixed income is not giving you the same risk reward that it once did. Like, how do you think, and how do you model these types of structural changes? Fixed income now is different, and we're in a zero interest rate environment, and we are in a low volatility environment for the most part. How do you think about the structural changes to models?
Yeah, so the fixed income one, because low vol will rise and fall, and I think we're pretty good at adapting to how that ebbs and flows. But fixed income markets have changed. I mean, like today is a perfect example. When that announcement came out, I happen to be up some on the West Coast. The announcement came out, bonds hardly went up, and the stock market was down close to 2%. I mean, things have just changed. And if you were long 30-year, treasuries in March, you went on kind of a wild ride. And so something is definitely different. And this idea that bonds and equities correlate negatively is kind of a recent, like a 30 to 40-year recent phenomenon that wasn't always true. And it's certainly questionable whether or not it's true with yields at their current levels. And I mean, just a quick, anecdote. One of my top research people here, he asked me, "Hey, Ryan, are people thinking about us as a good balancing to their fixed income portfolio?" And I was like, no, people think of us as a competitor to their fixed income portfolio. Like that's their safe asset that they think is going to perform similar to us in an equity route. And yeah, so I mean, when we think about how to adapt to this, it's a function of, is the volatility and the price action that we're seeing a true representation of a two-way market, or is it manipulated by central banks? Like, for example, we don't trade pegged currencies. And so it is an actual, topic of discussion here at Row. What should we do about the fixed income portfolio that we trade? It's becoming less and less justifiable to trade it exactly the way we do now. And sort of to, get back on the question you'd asked earlier, like going into Brexit, like how does systematic managers handle that? That was like our last really big event. And, it matters a lot. What are your positions the day before? So if your positions the day before are one way versus the other way, your reaction is different. And we looked, just our book, we just kind of did we polled all the different investment banks we talked to, and they said if it goes one way, prices will be here. If it goes the other way, prices will be there. We looked at how that would impact our book. We realized that even though our book's expected vol was around 12, 13, 14, that its true actual vol based on those projections was probably in the 20s. And so we felt like it was the right thing to do to reduce positions just so that we're projecting the kind of risk that we promised to our clients. And actually it turned out that cost us some money because the way Brexit went was profitable for us. But that would be the one way that systematic managers do need to prepare for events, is this: if the risk inputs that your systems are taking are not reliable and you have a good intuitive understanding that something big is about to happen. So, that it's on the table for the November elections if there's, a lot of uncertainty.
Yeah, and from my experience with systematic managers, I found that best practices, and this is very consistent, is they sometimes discretionarily reduce risk, but never discretionarily add risk. And over the past decade, there's been very few instances. I think the 2011 Japanese tsunami, where Japanese markets were closed, Brexit, maybe the Trump election, but there's been very few in between where they'll, dial down risk because of uncertainty, but not the other way around.
Right.
But you bring up a really good point about, I think the next big question, what to do with fixed income, but it's interrelated, is quantitative easing. And this coordinated central bank quantitative easing we've seen really since the great financial crisis, but in overdrive over these past 6 months. And in a lot of ways, it's distorted market clearing mechanisms. It seems like markets only go up. We have S&P 500 nearly at an all-time high. We're off today on the news, but in general, we're at all-time highs, which is a big disconnect between the underlying economy and the questions surrounding how we exit out of this. But when you see the liquidity that has been, this big wall of money that has just been pushed into asset markets, it's no wonder that markets are up and continue to go up. So maybe, Justin, when you think about this, like, it's very hard to be an allocator, and we have a lot of clients who are public pension funds. I feel your pain. How are you guys thinking about what to do? Because diversification hasn't necessarily worked that well. Hindsight's 2020, but over this past decade, if you had just had one investment in the NASDAQ or in the S&P 500, it would have outperformed just about every single institutional portfolio. How are you thinking about that, and how is your investment committee talking about where to put marginal dollars today?
So to answer your first question about rates, if you look at a 30-year history of public pension plan allocations, as rates have fallen, they've moved slowly into equities. And so, you probably had a 70-30 portfolio 30 years ago towards bonds, and now you've probably got a 70-30 towards equities, or 60-40 or something like that. And that's been a very slow evolution, and that's probably going to continue just based on how public pensions sort of by fiat determine what their actuarial, assumed rate of return is. So that's separate, I think, from how most of my peers operate. If you look at, and my peers, I mean people who specifically focus just on hedge funds, by and large, there are a few places like Hawaii and other pension plans that have this sort of crisis protection bucket, and hedge funds get embedded in that, so macro can serve that role. And most of the peers I've spoken with, generally do a portable alpha construct. And so hedge funds are sort of not part of the asset allocation. And so whether or not the market kills it or crushes it, or whether or not it underperforms, really isn't a decision for the hedge fund portfolio. Our goal is, as sort of Grant was highlighting, is to make consistent alpha. And so I'm much more, comfortable, with my managers making 3% in a year that Nasdaq's up 30, as long as they can make 3% when it's down 30. But to answer the question about rates and how it relates to the hedge fund portfolio, I think it's critically important for really the host of strategies that we're talking about now. If you look at why CTAs have performed well, and you look at where discretionary macro guys generate the majority of their P&L from, both of those strategies and the convexity they provide has historically come from rates. And that is very different, obviously, than a fundamental equity market neutral guy. And that's why these strategies have sort of ballasted other hedge fund strategies. You can do basic math on what bonds are going to provide, unless a 10-year bond, 5%, 50 basis point yields, they go to zero. You're not going to get the offsetting contribution to returns from fixed income unless you take, lots and lots and lots of duration. In the case of Japan, that would have proved a wise thing to do. As vol got lower, you could take more leverage, and you can do that. I think public pensions are probably going to have difficulty stomaching that if that's the approach that people took, just because it creates eye-popping, amounts of leverage. But yeah, I think it's a really critically important question of like the future of really macro and CTAs. What do you do? I think there's possibilities in FX. Things like the yen work pretty well. things like gold work pretty well. Maybe you can even do it in differentials like safe stocks, such as utilities versus the market. And there's lots of bond proxies that can work in a portfolio, and you've seen people make those shifts as well. But within the CTA space and macro space, I haven't seen that much of a move. So I am kind of curious to see what happens over the next few years.
Yeah. Justin, I know you had done a lot of work on alternative market CTAs. And I think that's interesting because within the CTA industry, which has been around for decades, one of the newer developments has been a focus on these alt markets. Can you talk a little bit about your work and how you differentiate managers on the assets they trade?
Yeah, so when we looked at the CTA space, there were a couple categories. There were traditional CTAs, and if I read the bios correctly, I think that's sort of what Grant manages at Crable. And, sort of medium term, the classic CTA. Then you have, and that's really, again, a lot of that's come from rates and commodities, and those are your bread and butter for providing convexity. And then you have short-term CTAs, which I guess would be similar to Crable's flagship product. And it's less clear if they provide convexity or not. And then you have, sort of other strategies, which, one hedge fund that does that's John Street. They're just doing different things, and they don't really have a correlation to anybody. You could argue they're, something like pure alpha. And if you look at the proxies, most managers are highly correlated to the SocGen CTA index. The shorter term guys have a fairly high correlation to the short-term trend index, and the other people that didn't, I just put them in another category. What's interesting about alternative trend is that it's very highly correlated with traditional trend. It's just added some excess return over the last few years. What was most remarkable about this, and this is, I think, really the most interesting question for me, I've never gotten a satisfactory answer for, is that the alternative trend markets and traditional trend markets, if you look at like some strategies that existed and some of the back tests, there's really no difference between them for the 15 years prior to 2008. And not all the markets existed then, but what the markets that did exist is very highly correlated with traditional CTAs. And then around 2008, the correlation persisted, but the excess performance gaps grew wider. We're there. My conviction level is not as high as I would like because obviously people are raising capital in the space. And so I think that I have to be realistic that the edge that exists is going to be eroded. That said, the historical excess returns from CTAs is already pretty low. You don't really make excess return. You really just get a correlation shift for free to your portfolio with cash rates embedded. So, so the question I can sort of pose back is, what do you think happened in 2008 that really led to this divergence when they were correlated, and then all of a sudden they stayed correlated, but the excess performance gaps got quite wide? My guess is a lot of people saw it in 2008 and did exactly what we're talking about. This is diversifying, and then they threw capital in it. And you can look at the assets. Everyone now, risk premium is doing it. It's highly commoditized on the traditional trend space, and it did what it was supposed to. But I also worry that it might be getting gamed. I worry there's too many people doing it. And the response that I got back initially was, I'm going on a little bit, but sorry, the markets were quite large. These are $1 trillion markets. Is it possible that CTAs are really large enough to move it? And I'm like, well, maybe. It's $400 billion, leveraged a couple times. That's $1 trillion. You think about pension plans, we're trillions, but we don't change our asset allocation. CTAs can go from 100% long to 100% short. Some of them go 300 or 400% long, 300% short. I think it does have enough potential to move the market. Maybe they're competing against each other. And smarter people are sort of front running and trading these things. So I think the divergence between alternative markets and traditional speaks to that, but I'd be curious to hear what you guys think about that as well.
Yeah, maybe Grant, you can take that one. You have a short-term and a long-term CTA. You have a lot of experience with alternative markets.
Well, okay. Honestly, we trade over 200 instruments, but we're not trading a lot of OTC derivatives, really any outside of OTC FX. However, Justin, I think you're on to the right answer. Look, the world is not one composed of infinite assets, even though it feels that way. Quantitative easing, those are big numbers, but in the context of how big the global economy is, they're relatively small, and yet money has to go somewhere. And you look at this rally that's occurred, so many of, frankly, the wealthy and large corporations sitting on so much cash, sort of the rally makes sense in that context. The idea that the growth in that space has no effect on the sustainability of the trend and outperformance in alt trend strikes me as incredibly unlikely. I mean, the growth in some of the alt funds, and they're great funds. I don't mean to criticize them because they're fantastic, but the reality is they've grown tremendously. And you mentioned it as well. It's not just some of the sort of the brand name excellent alt trend that we know of and can invest in, but it's also sort of secondary investment philosophies and some of the other passive products out there. So it's in my sense, in my way of thinking, I think it's very self-fulfilling, and it might not necessarily end if this continues. Why not if the asset growth continues? But I think it's a point of potential concern. And you flip the scale and you think about what we're trying to do here at Crable, and I think what's happening for Anoush and others. We're playing a relatively low capacity game, right? We can't run $40 billion doing what we're doing. There's no way we can push into a market microstructure and accomplish that. One of the benefits alt trend has is they're holding trades for months and months, and so theoretically they can. But what they're forgetting is, various different people are adding every month, every week. And when it ultimately comes time to do something else, that could be remarkably painful, which is sort of why March happened to begin with, the more traditional markets. So when and if that happens, I don't know. But it seems like that could be an inevitability. Meanwhile, in alpha creation, genuinely, hopefully positive convexity, volatility, sort of lending alpha creation, to your point, Justin, 3%, that's probably not a bad return in the context of running billions of dollars, because you just can't push a lot of assets there. And I think that's why you've seen a drift away from it. You can't run $100 billion doing what we're doing. You just can't. So it's limited. And I think investors ought to be cognizant of the fact that if it's genuine alpha, it's limited. And certainly the investment manager should be sort of on top of that as well. It's just how the game works.
Yeah, I agree. I think not a lot has changed, but with the classic momentum trend following model over the last few decades. But one of the biggest themes that has emerged has been almost the acknowledgement of the commoditization of the asset class, where you see lower fees, you see management fee only, and that's a big difference from the fees that we're charging at the beginning of the industry. So I would say that's one, like the trend only for low price, and then also the alternative markets is a new big development that has really taken hold, and there's probably a good dozen funds that are doing something like that at this point. I'm going to take a question from the audience. Anoush, it was asked for you. I don't know if you saw it, but it was more, can you discuss your RV approach? Like typically RV requires a lot of leverage because the spreads are so small. So can you talk about how you balance that out, the risk of taking extra leverage with the return from the small spreads you're trying to capture?
Sure. And that RV approach is something that we've held so we've changed a lot of things. We've evolved a lot in the last 20 years. We've been running strategies like this. But one thing we've held consistent is that pure RV approach. And from day one, we took the view not to be directional, not to have any beta in our portfolio, because we kind of realized that investors can get that elsewhere. They can get it elsewhere. They can get it cheaper, probably elsewhere as well. So for us, it was always about kind of that diversifying alpha source. And when you, if you like, draw those constraints, you really are kind of left with RV. And for us, it kind of made sense to have that approach. And you're absolutely right. By being RV in fixed income markets globally, you're going to have leverage. The U.S. Treasury and Canadian government bonds are correlated, and correlated quite high. And so you're long one and the other. Yes, you are going to take large positions. Now we have huge amounts of risk management sitting on top of this, and I think that's where you have to invest. Our leverage, we're on a 12-vol strategy. Our duration-adjusted leverage is approximately 9 times, which I think it sounds a lot, but it's what you need to have in your portfolio. We trade these futures and forwards instruments, obviously on margin, which allows us to do this, and we're kind of nowhere near pushing the limits of the risk we can run in the portfolio. So we're kind of cognizant of that. But the other thing we bring to our portfolio is what we call risk filtering or regime conditioning, which basically allows, if you like, us to systematically overlay the the risk allocation of our models with filters that basically turn some off and turn other ones on, depending on the underlying environment we find ourselves in. So that level of kind of risk management sitting on top of the portfolio does kind of allow particular kind of left skew protection to portfolios which are generally at risk to those things. So that's one of the reasons we have that dynamic approach.
Yeah, the risk of leverage is a topic that comes up quite often. And I think, imagine comparing a prudent approach to 9 times leverage versus a long-short equity fund that has a 50% or even a 10% position short Tesla, right? Can you imagine the decimation of that portfolio versus a prudently, 450 by 450 type of RV approach? Ryan, maybe I can jump to you because I think there's another interesting question. I think you'd be good for this one. How should investors differentiate between systematic macro managers? There's a lot of similarities, of course, like everyone is doing trend. Many are doing mean reversion. Many are doing some of these same factors. But how should allocators differentiate between GPs?
Yeah, and so
what are the right questions to ask?
Yeah, it's a very difficult problem to solve. Like, we definitely understand that. I mean, the best that I can say is look at, every manager is going to have a different performance profile. They're going to do well in certain scenarios and do poorly in other scenarios. And even if, alpha can sometimes ebb and flow, or sometimes you sort of interview with the hot manager and then all of a sudden their performance is just not quite as good as it was before. I think, that is solving for who's good by empirical data is definitely flawed. And I think there's been a ton of papers detailing that just doesn't really work. So, I mean, it comes down to just looking at, when does the manager perform? Like, do they perform at times that suit your portfolio? Do they only make money when you're already making money? Or do they, to Justin's point, maybe they just don't make enough money and it's not really of interest to, I think there was a question on the lineup as well about that, but what about total return? But yeah, I mean, I think so. One of the things that we'll go through is just say, where are the stress points in your, we had a potential client who was interested in, equity drawdowns over the last 10 years. So they sent us these ranges of dates. They're like, we're not super interested in how you did over the entire period. It's just, how did you do over these particular periods? And so that they were building a scenario. And they wanted a puzzle piece to fit into that spot, and so that they were able to narrow down managers quite a bit by who fit or didn't fit. And then it comes down to the traditional stuff of getting comfortable with the backgrounds and the education, all that in the experience. But I think to start, it's, does the data fit what you're trying to do?
Yeah. Thank you. I have another question. Maybe Justin, I'll throw this one over to you. What do you think about a combination of discretionary and systematic macro? I think that the 3 panelists here are all pure systematic, but I'm sure you've seen blends. Like, what do you think are the pros and cons of pure discretionary, pure systematic, and then the blended versions?
Yeah, it's not a tight answer. So I think there are 2 funds I've encountered that do this. Maniar is a Tudor spinout, and Outstone is a Blue Crest spinout. They both have this sort of man and machine approach. And I think if you're going to do systematic macro, I think there's a very strong argument for having some sort of like hands-on approach. I mean, even Ray Dalio in Bridgewater is our systematic manager in the macro space. It makes sense. He came out and he said, hey, we should have cut risk. Like, it's clear, like, their models are predicated on what's happening in the world. Well, clearly there was a lot of news that we knew was going to be very, very negative. And, if you've got backward, if you're looking at economic data to make your decisions, it's not surprising that like it performed poorly. And you saw that across the entire, systematic macro space. And Q1, it got obliterated, and macro discretionary did quite well. And so it's not surprising that happened. So I think there's a strong argument for it. And I think as we've seen the commoditization of CTAs, I think there's been some commoditization on the macro side well. I think that, even risk premium strategies, I mean, you can look at, you're going to think about what variables matter. Like, okay, well, let's look at which PMI, like which way PMIs are trending, or let's look at, you can combine some valuation things like earnings yields versus bond yields and those sorts of things. And that's going to put out a portfolio. But, and those things are all fairly easy. I think the same we took fundamental equity and we turned it into, AQR risk premium type products. And I think we've turned global macro investing and it's gone through a similar evolution. And I think that some of the edge that may have existed there is probably getting chipped away too. But that's the case everywhere. I mean, like that's just the nature of hedge funds is, if there's easy money, someone's there to try to get their hands on it. So yeah, I'm sympathetic to the approach. I think it makes sense. And, one thing that I will say that in general for systematic approaches is that they tend to be very centralized. There's typically a single risk taker. And it is nice just from maybe it's just an investment, like a sort of a logical fallacy we have in our heads. But at least I like the comfort of having a multi-PM approach. And you could do that on the systematic side. Like you could have someone run a currency team or whatever, and they all run separately. And so it's maybe the strategy's not working, but generally they're very top down. So it's difficult to know who to blame or what to blame. It's this thing isn't working because it's one giant, system. And so it's easier to if you're looking at a multi-PM macro approach, this particular trader, if you see alpha degradation across the whole suite of things, it's then you can say, well, these people aren't good at hiring. Whereas if there's a single one, it's harder. And so that's a secondary aspect, I think, of a systematic strategy is the centralization and not knowing the components.
Yeah, agreed. I think when I talk to discretionary macro managers, one of the qualities that really resonates is consistency. You'll hear about their process is the same. They're looking at the same charts. They're reading the same research. They're investigating in the same way. The investment process is very consistent. And what it looks like is a systematic manager. So I think in fact, that's the common denominator of the success of many of these firms is they've developed a process, not just made a few great bets, but a process. And perhaps in a decade from now, it won't be systematic macro. It'll just be macro. Everything will be macro because everything will be systematized in some way. So we have just less than 10 minutes, and I want to give all of the panelists kind of some closing time and closing comments to I don't know, perhaps respond to anything that is still left out in the open, or just anything we didn't get to speak about. So in no order here, Anush, would you like to make some closing comments for the panel?
Sure. Thanks, Chris. There was another question actually talking about moving the needle in pension fund allocations, and we'd obviously advocate a higher allocation to systematic macro if it was given. I think it's a fair point, though. I think sometimes people make investment decisions on kind of what it looks like in the portfolio as opposed to the impact it has in the portfolio. And I think over time that there's now enough evidence to show that having a diversifying set of investment strategies in your portfolio is the way to go. And Chris, you're right in saying that the last 10 years, if you just put your money in the S&P, you couldn't have done much better elsewhere. But that's the thing; we don't know what the next 10 years are going to look like. So for us, it's all about kind of continuing research. 95% of our time is spent day to day researching new data sets, new ideas. We've made a big push into alternative data over the last 3 or 4 years. Kind of been a very big advocate of that. About half our research is on newer data sets, and that's kind of really impacted the portfolio hugely. And some examples this year are that some of our slow moving models, as you'd expect, would struggle during periods like this, and they have. But actually, we've more than made up with that by having a diverse set of very complementary models looking at faster, more sentiment-driven data sets, and they've done really well, exactly at the time you'd expect them to kind of add value. And that's kind of satisfying to kind of see that when you change your research agenda to kind of spend time and effort and actually money, researching areas where we think it's going to be more important in the future. And I think sentiment and flows and things like that are going to be more and more important, it's good to kind of see some return on your investment. And I think we'll continue to do that.
Yeah, thank you, Anush. Ryan, you want to wrap it up for us?
Yeah, sure. I mean, I guess the only thing I can think of that we didn't really talk about is inflation threats. And it's interesting, they just never really come up. And it kind of plays into this idea of, how is fixed income, how is that going to fit in a portfolio? And I think it is definitely true that if you regress out the contribution of fixed income trading to CTAs, it's usually long and it's usually been pretty profitable. But again, they're not really biased to be that way. It's just worked out. They've gone up. So CTAs have been long. And I think inflation is really, that's where I just can't think of a better investment to be in than other than just a pure long commodity fund, because CTAs can turn themselves into a long commodity fund. They can go flat equity, short rates, and long physicals, metals, and things like that. And so, that was part of it. And I think, maybe one other thing that came up, this idea of systematic. So that you can have two systematic managers who have virtually no idea what the other one does, where one is more like us, that it kind of starts from a discretionary mindset of, okay, we have these beliefs and ideas about how markets work, and so we're going to systematize them so they can be applied efficiently and without, with discipline, versus like the team that figured out how to beat, the grandmaster chess players or Go or things like, they're doing machine learning that's completely different than what we're doing. It's both systematic, but it, that, plays into this question of what sort of manager do you want to hire? And I think that the right systematic manager has some discretionary input to their process. And so they kind of solve that issue that came up earlier too. But yeah, I mean, I think inflation is kind of the thing that when we look forward is like, what's our home run scenario? That really is what it is.
Yeah, no, it's true. The process with qualifying managers as systematic or quant is that is their process. That's not their asset class, and they're very, very different under the hood. Grant, can you help bring us home here with just 3 minutes left?
Meg, before she signed off, challenged us to add something positive at the end. I'll attempt to do so. I think one thing that's happened here is because passive investing has been so rewarding for institutional portfolios over the last 10, 12 years, you've mentioned it several times. There are good managers out there now that are underfunded in a sense. I think, there's capacity for sure on long volatility alpha opportunities. But right now, I think there's some good talent. I think also the industry, our industry, let's call it systematic and discretionary alpha creating macro-oriented strategies. We've wisened up to how the marketplace has changed. The marketplace these days is terrifying in some sense, right? Where you have no volatility the penultimate week of February, and then the world's falling apart 3 weeks later. And what do you do about that? And I'll tell you one thing you need to do about it is have a comprehensive solution around every element of adding value to your investors. The tech side, the research side, certainly transparency, client-facing side, it all matters now. There are managers out there that have capacity that are focused on those areas. And if they do, they can sort of tackle those problems that are created by the high-frequency trading community and others that have become fantastically interesting via modern publications. So the opportunity set is out there, and I'd challenge all of us to sort of push into it. We have an opportunity to get better, and they're out there.
Thank you, Grant. Always a pleasure. And Justin, we have just about a minute left. Any concluding comments?
No, have a great day.
Yeah, I like it. Let's have a great day. Well, thanks everyone, all my panelists, and thanks everyone for tuning in. And Meg, with perfect timing, we're going to turn it right back to you at the top of the hour for the next part of the agenda.
Okay, I wasn't expecting to come back on because it's you people who are important. That was terrific. I certainly learned a lot, and I hope all of our audience members did as well. I appreciate so much all of your participation. Everybody have a great weekend. Happy that it's Friday. Anush, you get to quit earlier than anybody being in London. Cheers. So thanks again to our supporters, our sponsors, and we will see you next week with our next webinar. Please look for an e-blast that will be coming out later this afternoon. Thanks, everyone.
Bye-bye.